The global economy has faced a number of challenges in 2023, from continued monetary tightening and elevated interest rates, remaining inflation risks, and obviously geopolitical conflict around the world. This uncertainty has been reflected in real estate demand, with companies taking generally a more cautious approach. Specifically in the office sector, leasing has declined in both the US and in Europe year to date, while activity in Asia Pacific has remained much more resilient. The bifurcation in the office market that we've noticed in the past remains and feels even more structural in certain parts of the market. Demand is incredibly strong for high-quality space that creates a vibrant employee and customer experience, enables productivity, and meets sustainability commitments. But the rest of the market continues to struggle, and we think demand is likely to remain slow through the end of the year and into the first half of 2024. Demand has also cooled in the logistics sector in the US and Europe as companies review their strategies and their supply chains, although take-up continues to be strong once again in Asia Pacific comparably. With e-commerce sales still rising and supply chains, as I mentioned, undergoing major strategic shifts, we think the structural drivers for the sector remain intact for the long term. With consumers prioritizing leisure experiences and travel during 2023, rebounding tourism and resilient spending are supporting the best quality retail locations and big parts of the hotel sector. Across sectors, completions that will continue to deliver this year and into next year will push vacancy rates higher in 2024, but a sharp decline in new construction starts due to financing challenges could lead to a huge supply crunch for new quality assets and especially net zero carbon assets in 2025 and beyond. On the capital market side, the rising cost of debt, rate volatility, and even recession fears have also impacted investment transaction volumes, which are 50% below last year through Q3 and at the lowest year-to-date level in a decade. Despite challenges weighing on lender sentiment, debt markets continue to be liquid, with loan originations diversified across lender type and alternative lenders emerging to provide financing solutions throughout the capital stack. The lack of deal volume is contributing to ongoing price uncertainty. The gap between buyer and seller expectations is actually holding steady, and the average number of bid counts that were increasing earlier in the year have leveled off to some extent in recent months. Liquidity and sentiment remain most resilient for sectors with the best performance fundamentally and the best long-term structural drivers, as well as in the highest quality segments of each asset class. Logistics and living continue to be the most active sectors globally, with 51% of overall investment volumes, while hotels and retail also have remained quite strong. Overall, we expect conditions to improve, but along an uneven timeline and an uneven path as we move into 2024.
High cost of capital and conservative underwriting are muting transaction activity, and that is keeping markets squarely in price discovery mode. But here in APAC, we have seen limited repricing to date. Fundraising in APAC is just as challenging as in other regions under the current climate. Denominator effect has limited capital inflows to commercial real estate. And dry powder for APAC reached an all-time high as deployment slowed. Across the region here, China was the most active market in the region, despite limited participation from overseas capital. And if we set aside Japan, the obvious market with cheap debt and currency hedging benefits, and we set aside logistics and industrials, which is still consistently growing in APAC allocation over the recent years, the emerging bright spot would be APAC's multifamily sector. It outperformed the broader market year to date, and that is against a decline in total direct investment over that same time frame. Majority of that activity took place in Japan, which is the most established market for the living sector in the region, and that was followed by China and Australia. A few things that make multifamily stand out here: the structural factors like urbanization and housing affordability issues, and also given its stable income generating profile and capital recycling for reallocation purposes, the living sector as a whole has moved to become a higher conviction strategy for some investors.
This year, we interviewed over 1,000 senior decision makers globally about their real estate technology initiatives. The survey covers investors, developers, and corporate occupiers. From these respondents, it is evident that companies have started to recognize that real estate technology isn't just a cost center, but is also a key differentiator that's crucial to meeting their wider objectives. At the same time, despite the ambitious agenda, most companies are struggling to adopt and to deploy technology effectively and successfully. And this is consistent across investor types and occupier industries. To help navigate through these challenges, we've identified a leading group of companies that are more advanced in their adoption and have achieved greater success with their tech initiatives. What we can see is that these companies are outperforming by focusing on three key imperatives: shaping an actionable tech strategy, building resilient operating model, and driving new and more agile way of working.
When it comes to asset management, solutions that help improve efficiency and reduce costs have been the focus to date for investors. But we are seeing a shift to technologies that support value creation and help increase returns. These range from risk management tools to tech solutions that improve valuation and underwriting capabilities. We see investors increasingly use technologies that can help with asset selection and artificial intelligence-powered analytical tools that can help inform investment strategies. At JLL, we use a broad range of technologies specifically for investors to help our clients make better decisions. In fact, roughly 1 in 5 of all our capital markets opportunities globally are supported by our artificial intelligence platform. Investors are looking at the smart building technologies and sustainability solutions such as automated energy management and sustainability monitoring and reporting. These solutions help achieve cost savings but also help companies meet decarbonization targets. Companies can see immediate improvements in operational efficiency and can demonstrate return on investments, so we expect the pace of adoption to accelerate. We know from our survey that occupiers are prepared to pay a premium for tech-enabled space, and this is exactly the type of technologies they are looking for.
We discovered a big disconnect between what employers expect from work today and what employees are ready to invest into their company. On their side, employers do not accept fully remote anymore. 1 in 3 have implemented compulsory attendance to the office. Today, productivity gains are seen as the second driver for enticing people to be back in the office. But employees on their side, for half of them, tell us that their home environment better supports their performance. The second challenge is that employers do not know how to orchestrate hybrid and to secure a harmonious office occupation. 4 in 10 today record office utilization levels below 40%. There is an imperative to redesign office space by thinking holistically about performance, sustainability, and well-being. And employers have started their journey already. 42% of office space has been adapted to meet the needs of hybrid workers, and 69% of organizations report that they are implemented shared spaces into their offices today. But employers still need to figure out what is the right proportion between individual and collaborative spaces. And they also need to monitor the impact of the changes that they have introduced so they can adjust continuously.